Welcome to Level 2, Lesson 5. My name is RIA the Trader from TradingWing.net. In this lesson, you will learn about the different types of stocks that are present in the everyday market. You will also learn about the characteristics of these types of stocks. So let's get started. Before breaking down the different types of stocks, it is important to define a few key terms. The first term is known as market capitalization, better known as market cap. Market cap refers to the total value of a company's available shares of stock. It is calculated by multiplying the share price by the number of shares. For example, if a stock price is $3 per share and there are 100 million shares, the market cap is $300 million. This term is important as it is used to determine the stability and reliability of a publicly traded company. To put it into simpler terms, a higher market cap means that the company is more established and poses a lower risk. A lower market cap means the company is either younger or in a niche market and therefore poses a higher risk. The second critical term is known as free float market capitalization, or free float market cap. This refers to the total value of a company's available publicly traded shares of a stock. It is calculated by multiplying share price by the number of shares available to the public. For example, if a stock price is $3 per share and there are only 20 million shares available for the general public to trade, the free float market cap is $60 million. Please note down the definition of free float, as this term will be used in later lessons and will support you in your future trading endeavors. Free float is used to define the number of shares available, not including shares held by company executives and governments. Free float only refers to the number of shares the general public can trade. Now that you have a greater understanding of market capitalization, we can begin breaking down the different types of stocks, starting with small cap stocks. Small caps are companies with a market cap between $300 million and $2 billion. Small caps are identified by a series of characteristics. For example, they are often young companies or companies within niche markets. They also stand within emerging industries. They are also highly risky to trade due to their low free float, causing share price to be easily manipulated. This will be explained further in a later lesson. The high-risk trading also comes from the fact that they are susceptible to failure due to uncertainties and the lack of company support and backing. Small-cap stocks have limited resources. However, there is a significant growth potential. There are also mid-cap stocks. Mid-caps are companies with a market cap between $2 billion and $10 billion. These types of stocks are also identified by a series of characteristics. Mid-caps are more established companies with some experience within their respective sectors. In terms of risk level, mid-caps pose a medium risk level caused by their mid-size free float. Therefore, they are less likely to be a victim of manipulation. These types of companies have healthy level of resources and backing and also hold significant growth potential. The third type of stock are known as large cap stocks. These are companies with a market cap over $10 billion. Large caps are also identified by a series of characteristics. For example, large caps produce quality goods and services. They hold a history of consistent dividend payments. There are also dominant players with often well-known names such as Google, Apple, Amazon, and so on. Large caps are low risk when it comes to trading, as they have a high free float and are extremely difficult to manipulate when it comes to share price. These companies hold plenty of resources and extreme levels of backing. However, large cap stocks are focused on steady and slow growth. If you are somewhat familiar with investing or trading, you may have heard of blue chip stocks. Blue chips are huge companies with great reputations. They are considered large cap stocks and are financially well established with years and/or decades of operations. Blue chips consistently present good earnings and consistently pay out dividends despite the market outlook. These are companies within the top 3 of their respective sector and are a target for majority of investors. A few examples of blue chip stocks are Coca-Cola and IBM. The final type are known as penny stocks. These are stocks with a share price under $5 per share. They are typically considered microcap or have a market cap of under $300 million. Penny stocks may also be considered over-the-counter stocks. These types of stocks pose an extremely high risk as they are a target for social media influencers and scammers. There will be an independent lesson on penny stocks and social media. For now, that concludes this lesson.